Essentially, what I see is that currently India is close to a $3 trillion economy. And for it to grow into a $5 trillion economy, it really needs to grow by almost 50%, about 60, 65% over the next 4 years. That looks very, very, very difficult. And the fact that India's current actual growth has trended down to 5% would make it even more difficult, because it will take at least a year or two for the Indian economy to recover from here on and reach its potential growth, which currently is around 7%. And I expect that to grow towards 8% over the course of the next several years. So as of now, the base case scenario is that India grows into a $5 trillion economy by 2026, and it should overtake Japan in 2027 to become the third largest economy. And then by 2030, by the end of the next decade, it should be closer to an $8 trillion economy. So how are we going to get there in terms of where is India's potential growth today, and how do we think about India's potential growth or the trend growth? So the traditional drivers of potential growth are essentially land, sort of labor, capital, and total factor productivity. The job market over the last few years essentially has been quite bad. If you see in this chart, labor has actually not added to India's potential growth at all in the last, since 2011-12, 2017-18, as has been shown in the latest labor survey, which shows that actual employment has actually reduced. Going forward, because India has such a young demographic dividend, and the government has taken some steps on the manufacturing side as well, but the key impetus to growth, in my view, is going to come from the services sector of the economy, which remains the key driving force for the Indian economy. The economy should benefit from higher labor growth, but the key boost to potential growth is essentially going to come from higher investment and increase in factor productivity. Because of the structural reforms of the last few years, what they do is they essentially increase the productivity of both labor and capital. And that is, in my view, should be one of the key defining features which will help India improve its total factor productivity growth and help India move from roughly a 7% potential growth economy to an 8% potential growth economy. However, what is really critical at this stage, where we're sitting now, where growth is at 5%, is how do we stimulate a cyclical recovery? Because in order to grow into a 7 or 8% annualized basis, you first have to come out of this current slump in which the economy really is. This is, in economics, there's this hypothetical concept of an output gap. What an output gap does is it estimates where your actual growth really is relative to where your potential growth should be. And if we look at the gap, the negative gap that has opened up currently in the economy, we are close to 2% below where our potential growth should be. And we are unlikely to close this gap in the next 2-3 years. In fact, according to my estimates, what I get is that potential growth should be increasing from now until the next few years. And at the same time, actual growth, potential growth should be increasing from 7% towards 8%, but actual growth would be increasing from 5% towards that 8% mark, which means in the first few years, the output gap will only get wider and wider. So only after 2022 will we start seeing a closure of the output gap. So what that means is that we are unlikely to see any inflationary pressures in the economy. Because only when your output gap is positive, you see inflationary pressures building up in the economy, because that is the time when demand is overstretching supply. If output gap is negative, then that tells you that demand is below supply. In some sense, the overall supply capacity of the economy is in excess, and that is why you have this output gap. So that's broadly on the long-term projections of the economy. So next I want to touch upon why did we get here in terms of what in my view, has been the critical defining feature of macro policy, which has led India into this current cyclical slump that we find ourselves very difficult to come out of. And from that perspective, the only policy, the big policy change which has backfired for the economy over the last 5 years is India's inflation targeting framework. There are multiple policy research papers which I have done, others have done, which find that there is actually no correlation between the RBI's policy rate and CPI inflation. CPI inflation, which consists of 50% of the food basket, is something that RBI's interest rates cannot control. And in fact, if you see, RBI has consistently overachieved its inflation target over the last 5 years. The white line over here, which is the YY CPI inflation, has consistently undershot RBI's targets. Even the 12-month rolling average CPI inflation has undershot the RBI's target consistently. The only time when you see it overshooting the RBI target is driven by food supply shocks. You cannot have an economy where the interest rates and the real interest rates are being dictated by food supply shocks. Today, when you have the RBI policy media briefing, you have the question being posed to the governor that real interest rates have turned negative today. So do you think that we still have space for policy easing? I think that is a completely off the charts question, because what are the real interest rates that we want to talk about? If we are talking, and if you're seeing the main problem as being in the manufacturing side and the industrial side, where the industrial sector in the latest GDP numbers contracted by 1%, then we should be looking at the real interest rates being faced by the manufacturing sector. And if we look at the real interest rates being faced by the manufacturing sector, then we should be looking at the lending rates that they face subtracted by the inflation within their manufactured goods. And over here, what I've done is, So over here, the white line is the investment as a percentage of GDP, and the amber line estimates real interest rate. So in order to estimate this real interest rate, what I've done is I've taken SBI's 1-year marginal cost of lending rate, and prior to 2016, I've used the SBI's base rate, and then subtracted WPI manufacturing inflation from that to arrive at the real interest rate. And you see a clearly negative correlation over here between higher real interest rates for the manufacturing sector and a decline in investment. Although some of this investment is also involves government investment and public investment, but if you exclude that public investment, we don't have that data, I think this negative correlation would be even more stark, because government or public investment is not so much impacted by real interest rates, as the government has that capacity to absorb the higher interest rates, whereas the private sector will not be able to survive in the face of rising borrowing costs. So this is something that we need to tackle. Just another chart. I'll not go into the details of this, but broadly what this shows is that the RBI's monetary policy framework of inflation targeting at 4% has been overachieved, because if you look at the CPI price level since 2016, when the RBI adopted this flexible inflation targeting framework, what you see is that the amber line should have been the RBI's target price level, if RBI achieved 4% target inflation every year. What the RBI ended up achieving was the actual inflation, which is given by this white line, which shows you that the actual prices in India currently are roughly 2 percentage points below where they should have been. So there's not only a negative output gap, there's also a negative inflation gap that needs to be filled up. And the way to incorporate that into policy making is to say that, let's say if in the past few years, RBI has undershot its inflation target of 4%, by a percentage point or half a percentage point, then over the next year, RBI will allow inflation to overshoot its inflation target by that half a percentage point to make up for that tight policy the previous year. But that is not what we have seen so far being acknowledged by the central bank policymakers. So I generally hope that there's some discussion around, or maybe some sort of a review committee which is at least mentioned in the next year's budget on the monetary policy framework, because in 2021, the government will have to come up with its new inflation target for the central bank, and that will be the time when this monetary policy framework for the past 5 years will come into question, and for that, the discussion needs to start now. But I think it would be a really smart move for, let's say, Nirmala Sitharaman to at least mention that they are thinking of, or they should announce in the budget that they want to set up a review committee to evaluate how the monetary policy framework of the last years has served the economy. And in my sense, I think the answers are very, very clear in my mind that monetary policy has been too conservative and has been too tight. And that is one of the key reasons why we are in this mess where we are today. So before I get into this chart, let me just give you a brief overview of what monetary policy has done over the last year and some sort of background into why we are seeing the kind of stress we're seeing in the shadow banking sector. So as Dr. Arvind Nirmani had mentioned in the morning, that India has been unleashing this move towards greater compliance, greater transparency, and all these structural reforms have had this J-curve effect. I completely subscribe to that view, and do believe that the short-run impact of these structural reforms has been negative. And in fact, the fiscal policy has been far more contractionary than at the face of it. Because not only the fiscal deficit has reduced over the last few years, also the tax to GDP collections have increased, which means that government has achieved this fiscal consolidation despite a slowing economy. And that really means that you've had a very, very strong fiscal contraction going on in the economy. Now, for the central bank, alongside such a major structural reform in the economy, to go out and carry out a tight monetary policy is something that completely baffles me. At best, the central bank should have accommodated carried out an easy monetary policy so that the economy should have been benefited from the government structural reforms. And this is something Dr. Ashima Goel, who's a member of the PMEAC, has talked about a lot, that in the absence of easy monetary policy, what has happened is that the growth has gotten stuck in a low growth scenario because you're not allowing a cyclical recovery to take shape. And as a result of which, the economy has not really been allowed to free up and then start improving on a cyclical basis. In 2018, when the economy was growing sharply around 8% or so, the central bank was very quick to jump and say that the economy looks like it's overheating and we need to start increasing interest rates. What had actually happened in 2018 was you were seeing pent-up demand because of the two shocks of demonetization and GST. In the short run, that demand has been constrained in 2017 and 2018 due to a low base, and this pent-up demand growth was increasing very rapidly. At the same time, you also had an oil price shock which led to higher inflation. And the central bank interpreted that to mean demand-led inflation, and it started increasing interest rates. It not only delivered 2 interest rate hikes, but it also squeezed out any liquidity in the banking system. And that is essentially what, together with the IBC and the GST and other RERA and other reforms that are being carried out by the government, led to a situation where you had defaults in the shadow banking sector. And it has created a major trust deficit of the shadow banks to an extent where the risk premium for the companies is now increasing. And just when we believe that the RBI's 135 basis points of rate cuts this year are now stabilizing the financial sector a little bit, the risk premiums were going down. RBI delivered another kind of shock policy on the economy in its December review, and it held the rates at 5.15%. And what that did was the white line, which is the sovereign 5-year yields, have shot up sharply after the policy. You can see they increased from 6.2% to almost 6.6%, a 40 basis points jump. The risk premium for the AAA rated guys also increased, which is the blue line. But the risk premium for the BBB rated guys increased even more sharply. The yields for the BBB rated corporates increased quite dramatically. And this is something that needs to be addressed. I was just reading the monetary policy minutes yesterday, and Chetan Ghate mentioned that, he's one of the members of the Monetary Policy Committee, he mentioned that reducing risk premia is something which falls within the purview of macro-prudential policy and not monetary policy. I think statements like these do more damage than good. In my view, I think the RBI and the government both have been delivering steps to tackle this rising risk premia. The government recently extended its partial credit guarantee scheme to allow banks to buy BBB rated plus assets from shadow banks. I think that is a positive step. So I think steps like these need to be encouraged. Maybe we need to have more discussion around a TARP or quantitative easing. Those steps need to be discussed. So I think I'll just stop over here.